Hi Forex traders, you're welcome back. This is Carries Trading Institute and this is my analysis for the dollar and foreign currency, specifically GBPUSD, because that's the only currency pair I love to trade, and the reason is because it's the fastest way to consistency, is the fastest way you're going to come into consistent profitability in your trading. Alright, so we're going to look at the dollar and see what we should be expecting going forth into the week, and also pre-FOMC, because we are expecting the FOMC news release coming out today by 7:30 p.m. So let's just go to our economic calendar Forex Factory. So you just go to the forexfactory.com. This is Wednesday, 12th April 2023. Just scroll down and take note of the important dates, the important assets, the type of events coming out, all right, and the impact it's going to have on the currency pair you are trading. So I'm trading GBPUSD. So you can see that by 1:30 p.m. GMT plus 1, we had a news release, which was a CPI on the dollar, and it had a high impact on this very asset and its associated pairs. Right, so we are still anticipating a high impact news by 7 p.m. and that's FOMC meeting minutes. It's going to be released by 7 p.m. GMT plus 1, and it's going to have a high impact on the dollar. Okay, so these are the news events. You really don't want to be in the marketplace when these events are happening, except if you are holding a position and you still perceive, based on technical analysis and confirmations, that price is still going to go in your direction. Okay, otherwise you shouldn't be looking to flip accounts during this type of news events. The first is NFP. NFP is released every first Friday of the month, and the second is FOMC. All right, these types of news events are really highly volatile and has the ability to induce quite a lot of volatility in the marketplace. Okay, we are talking about 100 to 200 pips in a minute or even seconds sometimes. Okay, so let's go to the dollar. This is my dollar, which is the benchmark asset. All right, I always love to refer back to the dollar because the dollar is the benchmark asset. So whatever is happening on the dollar, it has almost a direct relationship or an inverse relationship with its foreign currency. Okay, so if the dollar is bullish, we already know by default that foreign currencies are going to go bearish, and if the dollar is bearish, we already know that foreign currencies are going to go bullish. Okay, so we just go to the monthly time frame and determine institutional order flow of the monthly time frame. So previously we had price traded into a bearish mitigation block in a premium region where you use your Fibonacci between the high to the low. This is deep premium, all right, and this is mitigation block and has a fair value gap. If you are yet to understand what a mitigation block is, kindly refer back to the videos on this channel. You are going to learn a lot on some of these institutional reference points. There are actually 7 of them, so but you can learn all of it on this channel, okay, for free. So price gave us a displacement to the downside. Okay, this expansion to the downside that created a tiny volume imbalance right here in the monthly time frame. Okay, we saw how price traded into that volume imbalance. Previously I was expecting to see the dollar trade into a little bit premium, okay, of this immediate range, the high there to the low. I wanted to see price trade into consequent encroachment, which is 50% of this fair value, or even the bearish order block, but obviously the dollar is not doing that. Okay, so what do we see here? We see the dollar reacting off a volume imbalance as outlined right here. So let me just pick up this and show you what that is. The volume imbalance is price action where only the candle wicks are involved, with the body of the candles creating a gap. When you see that, that is a volume imbalance. It's an institutional signature. Okay, so once you see it, also pay attention to it. It's a type of fair valuation. So the institutions repriced into that volume imbalance, and currently we see that institutions are taking out previous monthly low. This tells us that the current institutional order flow is bearish on the monthly time frame. But where is it going to head into? It's going to trade into this wood low, which is sell side liquidity pool residing below it. Remember, liquidity either resides in a buy stop or sell stop, and sell stops are either residing below an old low or relative equal lows, or buy stops reside above old highs or relative equal highs. But in this case, we see it residing below that old low there, so that's the immediate drawn liquidity, and we still need to see price trade into a deep discount. All right, preferably trade into a fair value gap. Here we have a fair value gap right here. We have a bullish mitigation block right here. This is as far as the dollar may want to reprice into. All right, so on the monthly we are bearish. On the weekly as well, we can see that there has been a heavy bearish pressure on the weekly time frame. Price has constantly been taking out the previous weekly lows, which tells us that we are bearish on the weekly time frame. And just studying this week's candle open, this was the candle open. Once you just put your cursor on the candle, it's going to show you the opening price right above my chart here. You can see this place, this O here represents the opening, the H here is the high. So once you place your cursor on the candle, it's going to show you the opening price. So price opened at 102.095, then traded into 102.783 to form the high of the week. All right, why? Because I can see an IFVG right here. Okay, this is an IFVG. Okay, it's a type of fair value gap as well, where you measure 50% of the candle wicks. This is the candle wick. When you measure 50% of this and measure 50% of this, so price traded into that fair value gap. Okay, so and then to form the high of the week, and we started to see the reaction. Okay, so where is price going to trade into? The immediate liquidity on the weekly time frame is the previous weekly low. The low of the previous weekly candle, that's where the sell-side liquidity is residing, and the low of that monthly time frame as well, as outlined. Once you go to the 4 hour, let's go to the 4 hour time frame and see what we are doing now is called top down analysis. All right, this is our lower time frame, 4 hour or 1 hour time frame, and right here you would like to study market structure. So previously we've been seeing price forming lower low, lower high, lower low, lower high, and then price actually retreated. So what happened today during the the CPI news release was that, and why I sold the dollar and bought GBPUSD was because I saw that the dollar had created a displacement after trading into that internal range order block and fair value gap, gave us a displacement to the downside, then created another internal range fair value gap right here. Okay, right here, that price traded into that fair value and expanded to the downside, creating a bearish order block. This last buy candle that was traded through by these 3 consecutive down candles, which are the sell candles, formed the bearish order block right here. Okay, leaving this volume imbalance. So this was the volume imbalance. Look at it carefully. You can see right here, it's just the candle wicks in that are involved. Okay, the candle bodies do not really participate in this price action. Right here, the body of the candle and the body of the candle here, there's a gap in between. That's volume imbalance. So price traded into that level. That's where I short the dollar. And where's the dollar going to trade into? Sell side liquidity pool residing below the previous weekly low, and that's drawn liquidity on the monthly time frame, that old low and the inefficiencies below that is the drawn liquidity. So the dollar is bearish on the higher time frames, the dollar is bearish on the lower time frame. Structure is only saying that the dollar is also bearish, right? So let's quickly go to the GBPUSD pair, favorite currency, GBPUSD, guys. GBPUSD. So guys, this is GBPUSD chart. All right, so this is the daily time frame, or rather let's just go to the monthly time frame as well to do the institutional order flow of the monthly time frame. So you can see this is the monthly time frame chart. Price created a new low here. What are we expecting? We need to see price trade into internal range liquidity. What is that internal range liquidity here? It's this fair value gap, okay, of that premium level, the fair value gap. So we like to see this guy trade into that level. Okay, we like to see this guy trade into this level before we start to see confirmations to either go down. All right, so that's the drawn liquidity for me on GBPUSD. Okay, there is also a tiny fair value gap here, a bearish order block that has a fair value gap which is high probability. So I'll be paying attention to this guy as well, just in case price is going to retrace deeply into that level. That's where I'll be looking at. Okay, so on the weekly time frame, so on the monthly, again, if you take a look at current price action, the pound dollar had taken out previous monthly highs. All of these relative equal highs, it swept them. So that's to tell you that we are bullish on the GBPUSD monthly time frame. Then on the weekly time frame as well, we are bullish. Reason because we've been seeing price taking out previous weekly lows consistently in the previous weeks after price had swept sell-side liquidity pool residing here and formed even a smart money divergence. It started to take out buy-side liquidity residing above previous weekly highs. Okay, you can see that the previous weekly highs have been taken out, the lows have been respected. The next week took out the high, never went to the low. The next week took out the high, never went to the low. Next week took out the high, never went to the low. That is what institutional order flow is. Okay, we are seeing consistency of price movement, constantly taking out the highs without taking out the lows. That's a bullish order flow. Alright, so price swept buy side liquidity residing above these relative equal highs. Alright, there is a bearish order block here. If we had seen a bearish confirmation, we would have been selling this guy, but because the monthly time frame has a drawn liquidity, which is that sell side imbalance and the buy side inefficiency, alright, as captured here as liquidity void, one-sided price delivery that doesn't have an opposing price action. And then we can see there is a bearish order block on the monthly that has a fair value gap. That fair value gap on the weekly time frame has a volume imbalance. It's actually a volume imbalance. Look at this, a volume imbalance in between. So this is interesting, even more interesting. Okay, so you just go to the daily, just see what's going on. What we are doing, remember, is top-down analysis. Okay, every time price takes out external range liquidity, we want to wait until price trades into internal range before we continue with the trend, because the trend is your friend, of course. Okay, so price took out external range liquidity here. What is the internal range liquidity? The order block here. Remember, internal range liquidity resides in form of fair value gaps, order blocks, or other institutional reference points that I didn't teach here. It's only meant for my VIP students to have a full list of the things that I use to approach the markets. Right, so price traded into that bullish order block. Let's outline it right here. This guy, okay, and then we started to buy pound dollar on, this is the drawn liquidity. The previous weekly high is the immediate drawn liquidity, all right, and that's drawn liquidity on the weekly and monthly. So you need to go to the 1 hour or 4 hour time frame as well. So this is the 1 hour time frame. Okay, so what happened on the 1 hour time frame? Price traded into that level, then price created an expansion to the upside, broke structure right here. Okay, if you just use your Fibo level to measure the low to the high, we will like to be biased at 50% or below 50%, institutional reference point at 50 or below 50. That's where we would like to be buying. Alright, so if you take a look at this critically, there is a tiny fair value gap right here. So prior to this move, I was looking at this fair value gap right here that price had not traded into. Okay, prior to today's move, that's where I was looking at. So price gave us an expansion, lingered for a while, time distortion, and especially because there are two major events this week, the CPI and FOMC. Right, so price traded into this level, and that was where I bought the GBPUSD. Okay, immediately it traded into this level. I bought GBPUSD and sold the dollar. Right, so the dollar expanded to the upside, broke this high. Where is it going to trade into? The buy side liquidity pool residing above this, and the low resistance liquidity run. Okay, what's that low resistance liquidity run? Retail is already seeing a bearish trend line. Retail traders will have been selling and will have wanted to keep selling this, but when we see trend lines, what we see above it is, or below it, we see liquidity residing above trend lines or liquidity residing below trend lines. Okay, so price swept all the liquidity residing above this guy. This is the goal actually, that old high right there. Okay, so you can go down to 5 minutes time frame, see if you have an entry. Okay, so in the 5 minutes time frame, of course, because this was induced by the news, if you don't know how to use SMT divergence, you wouldn't have gotten an entry at all. Okay, because our entry model is we need to wait, price creates an external range to retrace into internal range, then we execute a trade entry. So what I executed using what is it called now, smart money divergence, or you can go to as low as 1 minute time frame to look for your entry signature. Okay, so even on the 1 minute you can see that there isn't really anything significant, except you are using smart money divergence. You will not be able to see it, guys. So price broke structure, created internal range, so price traded into that breaker block. What's the breaker block? Price formed the lower low here, then broke structure. I've taught you guys this. Then this other block that was violated is our breaker block. Institutions went back for the breaker, tapped into that guy, that breaker block, okay, and then continued that by side delivery. So guys, these are my thoughts on the dollar and foreign currencies. Please, if you like this video, don't forget to like this video, subscribe to my channel, and until next time, I wish you good luck, good trading, stay safe.